Hello, welcome back to another week of your Mortgage Market Movers Weekly, where we are going to break down everything that is going on in the economy to help you make more informed home buying decisions. Another week of volatility where rates are up, they're down, they're sideways, diagonal, left, right, northeast, northwest. Just kidding. But of course, the rates are volatile right now. That is definitely something to keep in mind. We're going to look at what's going on. I'm hoping, I think this is just my optimism coming out, but I think that we are on a path towards stability to where rates may be heading down and the volatility may be over with. We are going to check that out today. Just so you're aware, the average 30-year fix is down to 6.81 from last week's 6.83. It jumped up about 20 basis points or so, but hopefully that will be coming down. All right, so let's get over to the charts and check out what's going on. The U.S. 10-year. So, if you haven't been keeping up with these weekly, the U.S. 10-year is what we use as a proxy for the 30-year fixed rate. It is not the 30-year fixed rate, but it is what we use to see where the rates are heading, as rates are based off the U.S. 10-year yield. All right, so we see down the yield was fairly low back April 4th. It looks like it hit a low of 3.862. That all changed on April 11th, where there was a high of 4.59. So it's a pretty substantial jump. We're talking about volatility. These bars really represent the range daily that the 10-year yield traveled. So let's compare that just with something over here, right? We see some bigger bars, but it's nothing crazy. Big bar, But, this is huge, right? These are all big bars consecutively. Good news is it looks like things have been heading down since April 2nd. When it's red, that means it closed lower than where it started in that day. So this is good news. It looks like, from my estimations, what was happening was U.S. Treasuries were being dumped. Maybe a little bit of lack of faith in the good U.S. of A., but maybe that's starting to change, right? So when the U.S. 10-year is up, that means the bond market is down, and we can compare that with this blue line right here, and this is comparing the bond market to the yield. When the yield is down, bonds are up, and vice versa. So the bond market was kind of taking a beating here for a little bit. And I think that maybe things are starting to turn around. I think that bonds, people are buying them back now. I think that they're getting bought again. And hopefully some of that confidence in the U.S. economy is returning. But really, time will tell. These are all probabilistic things, and we have to look at the data, and that is how we make decisions, not based on what we want to happen. So that is the U.S. 10-year yield. Let's hop over and see what was happening last week. So when we look at these things, let's see. We want to pay attention to things that are going to impact the economy, like these big things such as like unemployment claims. This is pretty useful to look at. They came in. This is on a monthly basis, I believe. Weekly, sorry. So this is 222,000 unemployment claims as opposed to 216 the week before. Little uptick, but nothing big. Not a big deal. New home sales, this is good. So these are, I want to say, number of new single-family homes that were sold. I want to say that this might be new construction. Someone should fact check me on that. But this is good, right? So, we want home sales to be up, right? We want people to be buying. Lately, at least, anecdotally, here in Florida, it seems that homes have been sitting for a little bit longer. Rates have been climbing, understandably, so that's going to drop down demand. So supply is just going to be sitting longer. But we want to see that these new homes are being sold. When we look at existing homes, okay, so this is new construction because we have existing home sales right now. And these are actually down. This is on a monthly basis. So existing homes down, but new homes sold, I mean, they were up considerably. 684,000 was the forecast. 724 was the actual. Existing home sales, they were slightly down. I don't think that this is anything crazy because this is in units of, this is millions, right? So probably not that big of a deal, but existing home sales down slightly. New home sales were up. So things aren't looking terrible for sure. They're not looking terrible. Consumer sentiment, the revised University of Michigan, we had the preliminary and it was not great, but the revised a little bit better. So consumer sentiment might start actually being a little bit better. Maybe people are a little bit more optimistic. Inflation expectations 6.5%, not great. Previously it was 6.7, so maybe people are getting a little bit more optimistic. All right, let's look and see what's coming up this week. We do have a lot of employment information. So we have JOLTS, that's the job openings, and I don't know what the LTS stands for, but it's job openings. So we're going to see what those are. Previously 7.57 million, forecasted 7.49 million. So less job openings. I've been seeing that a lot of tech companies have been doing layoffs. I don't know if that's necessarily reflected in the greater economy, but I guess we will see as the data keeps coming out. We have pending home sales. That's going to be interesting for us. This is month over month. I think personal spending is probably interesting to look at too. We want to see how spending is going. And let's see. This is, sorry about that. Change in inflation adjusted value of all expenditures by consumers. Yeah, so just consumer spending. Let's see, more unemployment claims, and we have the unemployment rate. So yeah, a bunch of job stuff. That's what's going to be important for us. I mean, there are things like this purchasing managers index, and that's looking at managers buying for purchasing manager and manufacturing, which that's interesting to look at. So that's something to keep an eye on. But just for real estate, we want to look at unemployment. It's always good to look at, but yeah, pending home sales, personal spending, job openings, probably good things to look at. Like I said, the 30-year fix has come down about 2 basis points, 6.83 to 6.81. It jumped up 20 basis points. That's that volatility. And I just think it's so important. If you are waiting for the rates to come down and you see a rate and you're like, this is good, but it could be better. Really, I mean, I know it's a pain and like you don't want to go through it, and I get it, like I'm a loan guy, but really you can refinance, right? Like, do you necessarily want to? No, but I mean, like imagine waiting a week when you had a 6.62 and then it jumps up to 6.83. That it's gonna raise your the amount of money that you're paying over the course of the life of the loan, but also just your monthly mortgage. It's just something to keep in mind, this volatility. Hopefully it subsides, but rates have just been so volatile lately. So that's definitely something to keep in mind. And really, I think that's it. I think this has been a little bit of a shorter video. I'm going to try to have these not be so long. So if you're interested in a home loan, if you are interested in refinancing, maybe doing a HELOC, if you want to pay down some of those credit cards because you are one of those people that are spending like crazy, give us a call at 877-TEAM-MBL or visit us at our website, and you can contact us through here. We hope you have a great week and stay safe, everybody.